year is 1652 and the world is witnessing the Anglo-Dutch Wars. The island of Manhattan, then known as New Amsterdam, is a bustling Dutch settlement powered by its fur trade. As the English and Dutch vie for global trade dominance, Dutch settlers construct a defensive wall on the southern tip of the island. This wall, built to protect against English invaders and Native American attacks, gives birth to a name that will echo through financial history. By 1791, the Dutch have left and so have the English. The United States is a young nation burdened by debt from the Revolutionary War. Alexander Hamilton, America's first Secretary of Treasury, vows to establish financial order and champions the creation of America's very first bank. They need a name and end up calling it the First Bank of the United States. Despite the lack of creativity, the institution plays a crucial role in establishing a standard currency and boosting the American economy. But America's financial system has a long way to go. Bank runs are common practice and American investors are easily rattled, which leads to the panic selling of securities. To combat this, 24 stockbrokers secretly meet under Buttonwood Tree in 1792 to sign the Buttonwood Agreement, promising to only trade securities with each other. By creating a closed members-only financial marketplace, these stockbrokers promise to honor payments, only trade legitimate securities, and to charge clients the exact same rate, 0.25% per trade. They realize that if they can stick to these principles, the price of a stock should reflect the actual value of the stock. It ends up being a genius move and sets the foundation for what would become the New York Stock Exchange. Fast forward to 1870 and America is on the brink of a monumental shift. The echoes of the Civil War still linger, but the nation is healing, growing. It's the dawn of the Gilded Age, an era marked by rapid economic growth and a surge in industrialization by titans like John D. Rockefeller, and finance is the vehicle for this transformation. Enter Jay Cook, a financier from Ohio who sees an opportunity to build a new kind of institution, not just a regular bank, but an investment bank. His goal is to provide America the capital it needs to fuel growth. Jay Cook and Company helps underwrite the Civil War effort and becomes the first wire brokerage house using telegraph messages to confirm client trades. Meanwhile, across the Atlantic, two Jewish families, the Rothschilds and the Warburgs, are already making their mark on the finance world by pioneering cross-border banking in major European cities. Their influence eventually reached American shores, inspiring three German immigrant brothers in their 20s, Henry, Emanuel, and Mayer Lehman. In 1850, the three brothers set up a business to trade cotton in Alabama and called it Lehman Brothers. By 1858, the center of cotton trading shifts from the South to New York City, and Lehman Brothers eventually transition from commodities into investment banking. Their success sets a precedent for other Jewish bankers to follow, including Marcus Goldman. He's a 48-year-old German immigrant who begins making personal loans to businesses using his own money. His son-in-law, Samuel Sachs, joins the firm in 1882, and the two begin to build what will become Goldman Sachs, one of the most influential investment banks in the world. Goldman Sachs underwrites the initial public offerings of major companies like Sears, signaling the rise of the consumer retail sector in the US economy. But few individuals are about to have as big of an impact on American financial history as John Pierpont Morgan. Born into a wealthy family with a strong financial background, JP Morgan is destined to leave a mark on Wall Street. One of his most audacious moves is what we'll come to know as a leveraged buyout, a term that won't be coined until many decades later. In 1901, JP Morgan sets his sights on Carnegie Steel, a company owned by another titan of industry, Andrew Carnegie. Carnegie, nearing retirement, is open to selling, but the price he demands is staggering, $480 million, an astronomical sum for the time. But where others see an insurmountable obstacle, JP Morgan sees opportunity. He doesn't have the cash on hand to buy Carnegie Steel outright, but he has something just as valuable, a deep understanding of the financial system and the creativity to use it to his advantage. JP Morgan uses the assets of Carnegie Steel as collateral to secure loans, effectively buying the company with its own money. This is a bold and innovative move that carries significant risk, but the gamble pays off and US Steel is born, the world's first billion-dollar corporation. But the early 20th century also comes with its fair share of challenges. In 1907, a financial crisis ripples through the economy. It's triggered by the failed attempt to corner the market by the Knickerbocker Trust Company, a prominent New York City bank. When their scheme unravels, it leads to a run on the bank, causing it to go insolvent. This sparks fear among depositors who rush to withdraw their money from other banks, leading to a domino effect of bank runs. The panic of 1907 exposes the vulnerability of America's banking system and underscores the need for a central banking authority, leading to the creation of the Federal Reserve in 1913. As the 20th century progresses, Jewish-led investment banks are all the craze. Salomon Brothers is founded and quickly becomes a powerhouse in the bond market. Jacob Schiff, yet another German Jewish immigrant, sees potential in the sprawling American landscape, specifically in the form of railroads. His investment bank, Kuhn, Loeb & Co., becomes a leading railroad financier, helping create a network network that transforms the country. As the Roaring '20s unfold, America experiences an unprecedented economic boom and the stock market soars to dizzying heights. This is a time of great optimism and financial speculation. Everyone from the Wall Street elite to ordinary citizens invests in the stock market, hoping to strike it rich. But this period of prosperity isn't destined to last. In 1929, the stock market crashes, marking the onset of the Great Depression. In the midst of this economic turmoil, FDR assumes office in 1933 and immediately implements a series of reforms known as the New Deal. These include the creation of the FDIC to insure bank deposits and the SEC to regulate public equities trading. But the most significant piece of legislation to emerge is the Glass-Steagall Act, which forces banks to separate their commercial banking and investment banking activities, two activities that have become dangerously intertwined. This Chinese wall serves as an information barrier between banking divisions to prevent conflicts of interest. The Glass-Steagall Act fundamentally reshapes the banking industry and pushes JP Morgan and Company to choose commercial banking over investment banking. This encourages two JP Morgan employees, Henry Morgan and Harold Stanley, to leave the firm to launch their own investment bank in 1938. They called the bank Morgan Stanley. As the American economy recovers from World War II, we see a boom in new industries, one of which is the birth of private equity. In 1946, the American Research and Development Corporation is founded by Georges Doriot, a Harvard Business School professor who would become known as the father of venture capital. ARDC's aim is to provide capital for businesses that are overlooked by traditional banks and to boost private sector investments in businesses run by soldiers returning home from World War II. ARDC's most successful investment is a $70,000 check it writes to microcomputer manufacturer Digital Equipment in 1957. When Digital Equipment goes public 9 years later, ARDC's share is worth $38 million, reflecting a compounded annual return of 101%. Venture capital firm J.H. Whitney & Company is founded at the same time as ARDC, but over time, its founders, John A. Whitney and Benno Schmidt, begin to pivot into leveraged buyouts, an investment strategy that will define the latter half of the 20th century. Wall Street in the 1960s and 1970s sees the birth of several LBO firms, including Warburg Pincus in 1966, Thomas H. Lee Partners in 1974, and KKR in 1976. These PE firms realized that they can buy a controlling stake in companies with just a small amount of equity and large amounts of debt. Over time, they'll use the company's cash flows to pay off the debt. Meanwhile, in Omaha, Nebraska, a young man named Warren Buffett is starting to make waves. In 1965, he takes control of a struggling textile company named Berkshire Hathaway and transforms it into a holding company. Over the next several decades, Buffett's savvy investments earned him the nickname the Oracle of Omaha, and Berkshire Hathaway becomes one of the most successful investment vehicles in the world. But it's not until the 1980s that private equity truly establishes itself as one of Wall Street's favorite asset classes. American regulators finally allow corporate pension funds to invest in private equity funds, and Ronald Reagan lowers capital gains taxes from 28% to 20%. As a result, the PE industry sees an explosion in capital commitments from LPs, soaring from $2.4 billion in 1980 to $21.9 billion in 1989. A young man named Steven Schwarzman sees the opportunity to get involved and launches Blackstone in 1985, which will become one of the largest investors in LBOs over the next decades. Wall Street in the 80s is an era characterized by excess and innovative financial instruments. One such instrument is the junk bond, a high-yield, high-risk bond that offers the potential for substantial profits. These bonds are issued by companies with low credit ratings, making them riskier than traditional bonds but offering higher yields to compensate for the increased risk. They become a popular tool for financing leveraged buyouts, and the man behind it all is Michael Milken. A brilliant financier and a relentless innovator, Milken recognizes the potential of these high-yield bonds before many others do. He joins the investment bank Drexel Burnham Lambert and transforms its bond department into a powerhouse, raising billions of dollars for takeovers, including those of corporate raider Carl Icahn. The most iconic transaction of this era is KKR's buyout of RGR Nabisco in 1988 for $31.1 billion. But this era of excess doesn't last forever. The stock market crash of 1987, known as Black Monday, is a sobering moment for Wall Street. The crash leads to increased scrutiny of junk bonds and LBOs. Drexel Burnham Lambert is eventually forced into bankruptcy, and Michael Milken is sentenced to prison for securities fraud. As we enter the 90s, we witness a real boom in hedge funds. Ray Dalio's Bridgewater Associates launches its Pure Alpha Fund, and Steve Cohen launches SAC Capital Advisors. The 90s is not only defined by superstar investment managers, but also by an explosion of new strategies. Rather than only focusing on long and short equity positions, hedge funds now employ a wide range of investment strategies including macro, distressed debt, merger arbitrage, and activism. One hedge fund in particular makes headlines. Founded by John Meriwether in 1994, long-term capital management uses high leverage to make bets on the direction of interest rates. Despite being managed by Nobel Prize winners and a cadre of Wall Street's brightest minds, LTCM's strategy backfires in 1998 when Russia defaults on its bonds, causing a ripple effect in global markets. The fund, which at its peak managed over $100 billion, is bailed out by a consortium of banks for $3.6 billion, orchestrated by the Fed. But LTCM's collapse unfortunately won't be Wall Street's biggest fumble. In 1999, President Bill Clinton signs the Gramm-Leach-Bliley Act into law, effectively repealing the Glass-Steagall Act of 1933. The repeal allows commercial banks, investment banks, and insurance companies to consolidate, leading to the creation of financial supermarkets, offering a full range of services. It sets the stage for the biggest financial crisis since the Great Depression, but we first get to witness a new kind of frenzy, the dot-com bubble. At the turn of the millennium, the advent of the internet sparks a rush of investment into tech startups, many of which have little more than a dot-com to their name and a vague business plan. Investors, captivated by the promise of the new digital age, pour money into these companies, driving their valuations to stratospheric levels. The Nasdaq soared 582% between January 1995 to March 2000. Eventually, the pendulum swings back and the bubble bursts, sending the Nasdaq down 75% from March 2000 to October 2002. Financial markets eventually recover, only to be hit by another crisis far more devastating than the last. The Great Financial Crisis of 2008 is triggered by the collapse of the US subprime mortgage market. Financial institutions around the world, having invested heavily in complex securities tied to American real estate, find themselves exposed to massive losses as homeowners default on their loans. The crisis culminates in the bankruptcy of Bear Stearns and Lehman Brothers. The shockwaves from the collapse reverberate through the global financial system, and governments around the world scramble to implement massive stimulus packages to prevent complete economic collapse. In the aftermath of the crisis, a new form of currency emerges. Satoshi Nakamoto introduces Bitcoin in 2009 as an alternative to traditional financial systems. By creating a fully decentralized and secure peer-to-peer electronic cash system, Satoshi aims to eliminate intermediaries, the very central points of vulnerability that were exposed during the financial crisis. With a limited supply of 21 million coins, Bitcoin is also intended to protect against currency devaluation through inflation, something major global fiat currencies will experience in the coming decade. As the dust settles from the financial crisis, a new era of tech dominance unfolds. Coupled by a shift in consumer behavior and extremely low interest rates, FANG stocks reshape the investment landscape. By 2018, Facebook, Amazon, Apple, Netflix, and Google make up 14% of S&P 500's total market value. In parallel to these developments, the finance world sees the rise of a new breed of investor, the retail investor. Empowered by zero-commission platforms like Robinhood and online communities such as Reddit, these new investors share insights, discuss strategies, and band together to move markets. The rise of the retail investor disrupts the traditional dynamics of Wall Street, challenges the dominance of institutional investors, and the GameStop short squeeze even topples hedge funds like Melvin Capital. Meanwhile, celebrities and influencers don't want to be left behind. People like Serena Williams and Kim Kardashian launched their own VC and PE firms. Capitalizing on their vast social media followings and personal brands, they are able to attract significant attention and capital to their ventures. This trend not only underscores the blurring lines between entertainment and finance, but also highlights the power of personal branding and influence in the modern investment landscape. As we enter the new decade, central bankers begin to realize that they can't print money in perpetuity. The Fed's dovish monetary policy as a response to the 2008 financial crisis and the COVID-19 pandemic has led to record high inflation, and it's time to rein it in. In an attempt to curb inflation, Jerome Powell initiates a series of rate hikes, raising the federal funds rate from 0 in 2021 to 5% by 2023. This decision puts considerable strain on markets, particularly impacting the regional banking sector. Among the casualties of this tightening monetary policy are Silicon Valley Bank and First Republic Bank, who are caught in a duration mismatch. Inspired by the actions of his founder more than 100 years ago, Jamie Dimon is instrumental in navigating the crisis. JP Morgan Chase acquires First Republic Bank and works closely with regulators to ensure stability in the banking sector. As we look back on the tumultuous history of Wall Street, we see a story of innovation, ambition, and resilience. In the face of each new challenge, the financial industry has found ways to adapt and grow. It's a testament to the enduring power of financial markets and the human spirit.